Thanks for being here, and thank you for inviting me here as well. So I'll just make a very quick introduction of what we're doing and our fund, which we launched a little bit, more than 2 years ago. I used to, be at different places, and this is the fund where I'm investing, putting together, things from, things that I learned when you're doing long short and Lehman Brothers comes along. So you learn some stuff there, and then you learn some stuff when you work in big houses in the UK, and when you spend time with very good people around the world. And I think as we talk about the idea, it would be the way to understand how we invest, which is relatively intuitive at the end of the day and quite simple. Before we go into the name, which we'll get to that in a minute, I think it's fair to say that we've been through very emotional markets, very emotional years. I think we still are. Emotional, for some people very exciting, for some people very depressing, but you have here, everybody knows about the Magnificent Seven, up 29% CAGR since 2019, and that seems extraordinary, right? And some people say, why aren't you doing that? And then you have to explain that, it's just a couple of companies. But then there's always something that goes higher and faster than that. So some people will say, why do you have the Magnificent Seven? Why don't you have just NVIDIA? So everybody, is probably looking stupid at some point. It's interesting to point out as well, as everybody might know, that NVIDIA has gone a lot. Great company, great business, but it was down 66% before the last run-up, and it was down 40%, during COVID. So anyway, that's the context. And I think our breed of investors, the ones we are here, we might not be tempted by such greed of we have to catch up. Sometimes our clients might be, and we have to explain, which seems like an excuse, but we have to explain what we're doing, right? I think we're not tempted by that popularity and the chase of what's exciting. And that might serve as well. I might just point this one out. This is Cisco, 1999, peak. I put NVIDIA at the same point. So it's pretty similar, actually. And so Cisco dropped 90%, and they still haven't made the money back. So you wouldn't still be break even. They multiply their EBITDA 4.5 times since then. We could have looked at Qualcomm. Qualcomm did something very similar, collapsed 80+%, and then compounded, and they multiply the EBITDA 17.5 times. I was actually pointing wrong numbers yesterday because I was comparing something. So 17.5 times for Qualcomm. You only got break even in 2021. So we might get a chance, if NVIDIA collapses, or it might never collapse, but we don't care about that. I think, meanwhile, we here might be tempted by a different kind of greed, the greed that comes when you see things collapsing. And there's actually been quite a fair amount of things collapsing. For example, I just pulled a few out here. China Golden Dragon Index, that's China tech, down 78%. That's worse than the internet, the dot-com bubble burst back in the day, right? Renewables, 53% down. Biotech, 63%. Non-profitable tech, 78%. Whatever. I mean, we don't really deal in a lot of the stuff that doesn't make money, that are just visions. But this is just a sign that a lot of bubbles have burst. And with that comes opportunity, right? And this is our idea, where we are being tempted by this greed that we share, the greed that comes when something collapses. And this emotion, which is emotion to ourselves because of the things that are collapsing and not because of the things that run, many times the emotion comes because of thematics and narratives, right? And Orsted, for example, was a darling. It was just going up because there was all this ESG craze and people just getting carried away by the thematic of renewables and the flows and all that, and now it's all the opposite. And this is what's happened to it, down 84%. So greed kicks in, right? So we have to control ourselves. Thankfully, we have a process. Otherwise, we'd just be jumping, up and down. And our process is, I sometimes call it an emotional hack. How do we control ourselves so that greed doesn't take over, right? And basically, and this is where I said, well, you might be understanding how we invest, but we're looking for catalysts. We're looking for specific things that explain what went wrong, what might go right. We tie that up with the valuation, of course, has to be good with the context. So you don't buy everything or anything at PE 5. You sometimes should pay PE 15, or who knows? Depends on the context. It depends on the market, depends on the business, right? But the gist of this is that Orsted has made us very greedy. We have been able to control ourselves, but catalysts have been adding up, and now we are invested. Actually, we have a solid position in the name. Quick summary: some people might know the name or not, but this is basically the largest offshore wind operator, developer, construction, engineering company. They do everything in-house because they're the best. They call that the EPCO model, right? Engineering, procurement, construction, operation. That's the first. So they're so good at that, and they're the largest actually in the world. And they have a lot of records. The first offshore wind, the largest, first one, second record for largest, third record for largest. They're building the fourth record for largest. A lot of first in Asia, first in the US. I mean, a lot of records. And a very important part of the model, which a lot of people are now copying, is the rotation of assets. So they do something that nobody else can do as good, and then they come to Orsted and tell them, can I have a piece of that cake? And then they will rotate, sell part of that, capture the NPV, and recycle the capital into a new one, right? They have 80% of the EBITDA from now to 2030 contracted. That's massive. And that hasn't changed from 3 years ago. It's just the problems are different, and I will come to that. And it's a large company. I mean, we don't really have to find a lot of value always going to small caps. This is a 20 billion euro company. Okay, that's quite small now compared to NVIDIA, but it used to be a fair-sized company. So, if you put it all together, very low debt, by the way. I mean, this is a sector where a lot of people can build projects with a lot of debt. They lever it up. Orsted don't do that. And when you put it all together, it's actually got a lot of ingredients. I mean, it should appeal to quality investors. It should appeal to catalysts, as we are investors. It should appeal to thematic and growth investors. It should appeal to value investors. It's got a lot of ingredients. We think it's got at least 50% upside. And it's got risks, but, you want to run these risks in this business with these kind of people. So let me tell you why they are a great operator. These are some slides you can pull from their presentations. They have an incredible amount of information in their presentations. On the left-hand side, you see how the size of generators was going up. A bit of a Moore's law on renewables, borrowing from tech. So the bigger you can make these things, the cheaper you can produce the energy. And you can see how the generation cost for energy was going down. And that's a blessing in the past, and it was also a bit of the reason why they got a lot of these people in trouble. On the right-hand side, you can also see how they can operate better than OEMs. So when they take over the generator from the OEM, they are actually to run it better with higher capacity utilization, lower OPEX and all that. So great operator on the running of operations, which is very important, given these things last 30 years. And this is very important as well. Great operator on the constructing and on the procurement, on the execution of projects. These are multi-billion projects. If you have a slip on any part, there is a lot of knock-on effects, and it could cost you a lot of money. And this is something that actually explains what's happened recently. But you can see all these projects over these many years, they always were building on time, building on budget. All of them, including Hornsea 2 in the middle, which was in the middle of COVID. And then there is this Changhua in Taiwan. But they have an incredible track record of building on time and on budget despite COVID. And COVID is a big, big issue. So Hornsea 2, the example here, 2 months delay, still on budget. That's great execution, and also something that I realized when I was keeping an eye on this company a long time ago, actually, how well they were, ring fencing and bulletproofing their operations. They were contracting critical capex for a long time in advance. For example, they have 80% of the steel contracted up to 2030. So they were very cautious, not just with the balance sheet, very low debt, but also with their execution. just in case. Who knows? Nobody knew COVID was coming. Nobody knew, you would have a complete seize up in the value chains, right? But they were very cautious. So, in theory, and they've been for a long time, they were very good operators. Farm downs, I explained to you, they do construction and they sometimes rotate assets. This is part of the strategy. It's been for a long time, and they've done a lot of rotations. They have an incredible track record in capturing 100% of the NPV. So when they sign a project, I'm going to build you a 1 gigawatt generation plant. I'm going to fix the price with a PPA. I know how much I'm going to make, and this is my NPV. They are able to sell that. Somebody will pay them 100% of the value, and they can recycle the cash to make the next project. So that's, again, very good track record. Their assets appeal to investors. This is also important because it's not, I mean, this is all upside. So when they build a project, and you see there, they target between 150 and 300 bips above their cost of capital, and that's excluding farm downs. So farm downs are a boost to that, but they are able to extract extra profits from that. This is also a quick view of some of their farm downs over time and how much as a percent of their invested capital they were able to extract extra. This is profits. So as you can see, a very good track record in terms of farm downs. And as I was saying, they target 150 to 300 bips above WACC. They include there a lot of the overheads and costs, which other companies don't do. So when you talk to an oil company and they're targeting renewables, they will tell you, we target IRRs of, 7%. They're not including overheads. They're excluding that. Orsted do include that. So they are actually more conservative there, and farm downs are extra, as you can see on the right-hand side there. So boost to the returns, good track record in building, good track record in farm downs. And I wanted to show you a very quick, financial exercise so that everybody's clear with this farm down model. On the right-hand side there, you see, a quick little table for a 1 gigawatt offshore project. And then again, you have to understand how much capex this costs. And we've done, a lot of work to get to the detail of these things. The load factor for the plants, what price might you sell it at, what kind of tax, rebates might you get if you're in the US or not, etc. But anyway, you might invest a total capex, like in this exercise, of 2.5 billion. Third line. Orsted will target, for example, with an IRR of 9%, they should be able to extract 386 million of NPV creation from that. That's a 15% NPV creation for your 2.5 billion. The beauty of this is they will sell to somebody that might have a lower IRR, and this was the model before. So, if you are an endowment and you have free capital, permanent capital forever, you might be happy with a 5. And this is a 25, 30-year visibility on projects. So if you were to lower your IRR by a few points down to 5%, then that's a 320 million extra to NPV to Orsted if they sold 50% stake, which is what they typically do. They sell 50%. And then also, if your buyer wanted to lever this project up, because this is with zero leverage, then you might extract another 191 million NPV for Orsted. So overall, Orsted in this exercise should be able to extract 897 million, which is, above 30% on their capex invested. This is the exercise. This is how they generate this extra above their targeted original IRR. This is offshore. They also have onshore. Effectively, of course, offshore is a lot more expensive, so you deploy more capital and you will generate more. But in terms of capacity, they should end up probably about 2/3 offshore, 1/3 onshore, but much more EBITDA coming from offshore. But the exercise is the same, and they keep doing rotations of assets. Now we come to the catalysts. So I explained to you the model, explained what they tried to achieve, and they were running up. People loved it. Flows, from ESG and et cetera, coming in. And then we hit 2021 when interest rates started going down, because they were basically a zero, I guess. But actually, people started to think, oh, interests are going to go up one day. So things started to come down a little bit. They considered Orsted a very long life type of asset, which you discount your cash flows to the present, and then that's going to be worth less. So it collapsed 50%. That's more or less the time when we initiated with a small position. I have to say, I know I'm typically wrong because I'm very early. So that was one thing that was out of the way. I understood the model. They had a very, very punchy growth target in capacity, which you can think of, and the rotation and everything, and it really made sense to be there. But there were things that were still missing. For example, we know the sector because we have a big investment also in cables. Company makes cables and connects, networks and offshore wind, etc. And we knew there were not enough cables in the market. We also know ships, installation ships. We knew there were not enough installation ships in the market. We were seeing turbine makers losing money, profit warning, every quarter. The value chain is not right. Something might just happen here. I know these guys have locked in the steel, 80% of the steel until 2030. I know they locked in the turbines. They locked in a lot of things, and the company would say, no, everything's fine. But you never know. So we had a small position and kept watching. And then early 23 came, and we like these negative catalysts because they clean up, right? They take all the problems out of the table. So the first impairment, happened in early 2023, which actually related to Q4 22, and that was quite small, 2.5 billion. And things started to perhaps roll, right? And then they had a capital markets day in 2023, June-ish, and they said everything was fine, and they increased all their targets. But then summer went through, and then they came in September, and they said, oh, sorry, we made a mistake. We might have to do a 16 billion write-down. The market didn't like that, so it started to come down quickly. And then we started to talk to the company a lot. When I say a lot, they probably hate us now. But we went through all the projects. We understood what's protected by inflation, which, by the way, is everything in the UK, which is like more than about 80% of the current capacity. So high rates do not hurt them very much because high rates go up because inflation goes up, but I get inflation, so I'm fine anyway. But we started to talk to the company. We started to understand where they might have been too optimistic and where extra problems might come. They had one project, for example, which was quite representative in New York, where they wanted to get a price increase because inflation had gone up massively over the last few years, and they couldn't just make that work. And they would invest billions if they couldn't get the money back, right? So we needed to wait for that. And New York said, no, we don't adjust the price. And we'll come to that in a second because that was below 100. And then the second impairment came, and they said, no, you know what? The original impairment of 16 billion, which we thought is actually going to be 28 billion. The market didn't like that either, of course. It just went down like a rock. We already were very close to everything and understood where the limit was. It was trading below operating assets in the UK and Germany and Denmark, most of it with inflation protection. So we built our position around there. Not all, because we needed to wait for one last shoe to drop. Do they need a capital increase or not? And that was going to come, right? So all these negative catalysts, we are very close to them. We tie that with the earnings potential, and with evaluation. And I'm going to show you the ugliest chart I've ever made in my life. So much information here, but it's just relevant to show you that things happen which eventually drive share prices. These are all positive catalysts, good things that were happening, right? At the early part of the chart, as we were having a lot of negatives, we were also having a few positives. For example, it turns out that it was not just Orsted that was wrong, and industry started to become much more disciplined. Vattenfall exited a very large project in the UK. Then we had Avangrid, owned by Iberdrola, exiting 2 projects in the US as well. Then a while later, Equinor and BP separated, and you started to see, the snowball that projects are going to be cancelled everywhere. And that's good, right? Because suddenly brings discipline. Adults come to the table and make decisions and tough choices, right? So those all were very good things. One big bulk of catalyst, discipline in the industry. Then we had another interesting catalyst, which was that the AR5 auction in the UK for wind offshore had no bids whatsoever. Nobody bid for anything in the UK. Another wake-up call, discipline in the industry, right? And I was loving that. And meanwhile, you had all these profit warnings, which actually come from 3 years ago, and now we're saying these new things that are happening, right? A second type of catalysts was that, meanwhile, farm downs continued. For example, Orsted managed to sell Gode Wind 3, a project in Germany, and they managed to sell it at 3.7 million euros per megawatt. That's a very good valuation. So there was still investment appetite in the industry. People owning the market, investors want this. And bottom left, you can see there a lot of deals have happened. Some very recently in Cadiz, KKR is trying to take it over. Iberdrola is trying to take over Abangrid. Eversource sold to GIP. They share a project with Orsted. Well, anyway, a lot of projects. Ponte Gadea, very large family office in Spain, were buying, and that's onshore. What I'm saying here is investors want these assets. That's very good. And we had then another interesting catalyst, which was suddenly November-ish, 2023, there was a signal from the Fed that interest rates might not go up anymore. So we had the interest rate are not going down and might go up. Now we have interest rates might stop going up and might go down at some point. That was part of the reason this whole thing started to unravel. So that's a good thing. And then we had another type of catalyst, which is governments realized the industry and the discipline was rising big time, and if you want projects, you have to pay for them. And suddenly we had the New York round 3 auction price, $145. You remember the New York original price was below 100, and now they come months later with a minimum price of 145. UK AR6, so next auction for the UK, prices plus 66%. So governments are realizing. New Jersey, $146 to $176 per megawatt. Somebody might say, these are very high prices, then renewables don't work. But renewables are not just about the price. They will give you, and some of these renewables, right? But they will give you energy security. So you will want to have some of your energy under control, and this will give you that, right? And also some of those prices in the US are very expensive because the US has no value chain. So if you want to build in the US, you have to use US steel, and they don't have that. They don't have the towers, and that is actually some of the issues that have hit Orsted. They don't have installation vessels, which have to be Jones Act. Again, you have to build them. Again, those are delayed, and that's also what hurt Orsted. So the high prices are paying for that value chain being built. And then I think very specific catalysts for Orsted, we had all the write-downs, and suddenly we had the last capital markets day, which reviewed their targets. And most importantly, they said, we don't need a capital increase. This is how we're going to fund our future. They've lowered their targets, and we're good to go. And by the way, we give the green light to Hornsea 3, very large, actually, again, the largest project in the world, because the UK has managed to find a way to, help us with the taxes. Otherwise, we don't build it. And very recently, Sunrise project in the US, $150. That's the one they had to cancel because they didn't give them a little bit of an increase, right? So we've had all these very bad things, interest rates, value chain, and flows coming out, and we are now seeing all these very good things, and the market is still not realizing. Well, somewhat not realizing yet, although it's up, big time. It's more than 50% up from the bottom, of course, but we don't expect to buy exactly at the bottom. Just to give you again the context of the positive catalyst, you can see the circle in the middle. All those are the projects that got in trouble. And those are projects that got, green lighted during a very specific time. So if you were very earlier than that, you had no value chain problems. If you were later than that, you could walk away, scot-free. But if you were there and Orsted in a sense, was a bit unlucky because they had a lot of the projects coming up there because they won them because they're very good. And then they got hit by the value chain in the US, mostly in the US. They had no trouble in any project outside of the US. So again, that's important to point out. But on the right-hand side, you can see the table. It's not just them. A lot of other people got hit. It's just that they're a pure player, so it hurts more. But again, positive catalyst, this is what's happened since then. So the projects in the middle, accepting low prices, and now you see the projects on the right, prices going up, as I just described. So this massive 180-degree turn in discipline in the industry is for real. And this is happening exactly at the same time as, one, we're seeing interest rates not going up anymore, they might come down, but also you're seeing the inflation in the value chain coming down very, very steeply because the disruptions from COVID and the mismatch in timing for the new capacities is being resolved. So, you can think that any project they sign in the next 2 to 3 years is going to start with a very high interest rate reference base because the rates today are 5%, and they're putting in a lot of contingencies and explaining inflation is very bad and we need this price for so and so, and governments will buy that. And these guys are going to get incredible projects on the books in the next couple of years. So the extra catalysts we expect from Orsted going forward, will be farm downs. They need to sell good projects at good prices. And they have, a few that will happen this year in 2024 and 25. We also want to see new auctions at good prices, as I just described. They will benefit from the very good interest rate references, plus the contingency risks, plus the value chain being expensive, and they will put that all in the book, and the government will take it. We need to see no more surprises, and over time, confidence will build. I think the Capital Markets Day was incredible. They gave a lot of detail on everything, how they will fund things. They lowered the targets, and I will just give you a couple of snippets in a minute. But it's really, really realistic to double your EBITDA. They will see write-backs. Some of the projects which they wrote down were putting everything in. What if we cannot reuse anything from the old project to the new project? Well, that's not going to happen. I've talked to them, right? So turbines can be reused, cables can be reused, almost everything can be reused. It's just some things that cannot be reused because of the slot. So an installation vessel, you cannot take this slot and put it there because the slot is now. It's not the vessel, it's the slot. But a lot of that can be reused. And now, because they just got Sunrise, by the way, so I just said $150 per megawatt, that was already including some write-downs in case they wouldn't get it. But they've got it, so they will get the write-back. As I said, EBITDA crystallization. So we are now looking at a company which is trading below 9 times, about 8.5 times EV/EBITDA. EBITDA converts very, very highly into free cash unless you're investing. So you can think this is, a 10% plus free cash flow yield company if they do not reinvest. That EBITDA, which is 24 billion last year, which was 1 billion extra versus the guidance, is going to be, almost double. And 80% of that is contracted. Visibility is incredible. Lower interest rates, we'll see. I don't deal in macro, but it's going to be difficult to pay the amount of debt that's out there with current rates, so perhaps a little bit, they will come down a little bit. And, like I said, investment appetite. These are going to be very scarce renewable assets, and I will give you a couple of pictures now, but people are keen to own some of these. So just to put in context, the tailwind, because I said this is almost like it also has a thematic in growth and, sort of ingredient to it. But, the market has very little offshore wind today. It's about 32 gigawatts in the world. Targets globally are about 200. So that's a lot to build. Then we have onshore. Like I said, they have a bit there. That's also going to go up a lot. And they also have this P2X, which is powered to something else, which they will double. They will try and make some money there, but they're very rational in the IRRs. In 2024 alone, we're going to see 40 gigawatt plus of tenders for capacity, and that's a lot. Look at the prior years. It's never been that high. So we're going to see the most projects being tendered at the time when rates have been highest, contingencies in the value chain are highest, and you can lock in the best IRR in your life. So this is coming. Some of the key markets for Orsted are actually some of the most active as well. And you can imagine when you have Hornsea 1 and Hornsea 2, then you're building Hornsea 3. When you do Hornsea 4, you're sharing a lot of the infrastructure, and it's, execution is a lot easier. It's the same people doing it all over again. You can share, you can share cost, you can boost your IRs a lot. So they're doing quite a lot in the UK. They also have quite a lot in Germany, quite a lot in Denmark, quite a lot in Taiwan, which they started, and they almost have already 1.8 gigawatts operating there, Netherlands and in the US. And they decided not to worry with other markets where they're not so active, because you know what, there's enough for me here, and why bother? And I already run into trouble. So, I can really do my investment plan with these markets, and more than that, because if I show you this, on the left-hand side you have what BNEF thinks installed capacity will be for the countries on the right, which are the key countries for Orsted. And they say, well, 109 gigawatts by 2050, 2030, right? Not to get carried away. Countries' own targets is 180. So, something doesn't add up. So we need to go from 28 to 100, or perhaps to 180. So it's a huge amount of new capacity has to be built, and Orsted is the best company to do it. And to be fair, they don't really mind. They don't really care. For offshore, they just need to get 3 gigawatts extra, and they will meet the capital market stage. So 109 or 180, but they just need 3. That's how conservative they are. And this is what's locking their EBITDA for 2030, just 3 extra. The light blue is what they're already building, but they already know and they already have control of that, right? Then you have onshore, second bar. They need to lock in 5 or 7. And if I take you back there, it's 2,000 is going to be added globally. They just need 5 or 7. It's really doable. These guys can do that. That takes your EBITDA from 24 to 44. We'll see, right? And that is very, very, very tangible. So, yeah, this was tough. We had to value the company, and we had to go through, almost every project. Some of 100 megawatts we probably didn't do individually, but you can see here on the right-hand side the capacity, which they target to have between 35 and 38 if you add everything up. It's 19 gigawatts, which we already touch. Offshore, and they need to add 3. That will take you to 22, and then you have onshore 6.4 today with one which is 1.6 under construction. They need another 6, and so on and so forth. So if you value all that up by discounting by the cash flow, because we know the prices, because they're locked in, they have 20% open exposure to the market, which they hedge. And that was one thing that they learned, which they did bad, and they were unlucky as well. But now they hedge much more conservatively again. So we get to 245 billion Danish kroner sort of target. We had to take away some of the debt and hybrids they have. And then I think it's fair to think about what happens if rates go down by 100 bips, because the market will look at that. So that gives you another 48 billion. And we haven't included anything for what if they farm down and lock in some extra NPV? And what if the buyer wants to lever up the projects a little bit, so they're happy to pay even a bit higher prices? That would give us another 60 billion or so. But not including that, this basically takes us to about 50% outside. And I think this is really really special. I mean, we have an incredible quality company which has proved their worth, which has been hit by something quite specific over a specific cycle and period in time. They've learned things, but it hasn't really changed what's coming, right? And at the end of the day, this is Well, the capture is what we do. We go after companies where we understand where the direction of profits will go, because that's where the market will go. EBITDA here is going to double, and we look for specific catalysts so that we understand and we can actually point to why is this profit going up, because of this project and that project and this farm down, et cetera, et cetera. So anyway, I've got a great team that helped me with the most difficult stuff. So I try to, I speak, but they do. But anyway, this is how we do things, and Orsted is one important position for us, and I'm very happy to take some questions if anyone has any. Thanks so much.
Hi, thank you very much for the presentation. I have two questions, if I may. The first one is on shareholding. Having a state as the main shareholder is usually not the best for investors. So what would be your take on having Denmark with 50% of the shares? And the second one is a bit more general on the process. I really like the slides you did on the timing and the catalyst you are waiting for. It's as you said, it always looks easy when when the sun is shining, and a bit more complicated when you're in the middle of the storm. And I was wondering in your process if you have identified a general rule of thumb in terms of timing of when to buy after you get the first piece of bad news. Because as many investors, and I would include myself first in those, we tend to invest too early and sometimes exit too early as well. Thank you.
Thanks. So actually the Danish government seems to be very market friendly and oriented, and I've discussed it with the company. They don't really interfere in their operations. So it is what it is. Actually, market was happy to pay 1,600 for this when the Danish government in the share register, and now it's 300 and something. So that hasn't changed. So that's not one thing that has changed. So for me, I don't think it's a very important factor today. I mean, I agree with you. It's not always ideal, but I might prefer some governments to some people sometimes. Who knows, right? And in terms of the timing and the catalysts, no, I don't really have a rule of thumb, to be honest. I just we tend to look at the catalyst and try to size the impact, and when we realize one, the whole impact and then some is in the share price, and then when we are talking to the company very closely and understand that nothing else should be expected, because for example, if you look at the UK projects, you know exactly what they are. When we talked to the company and understood there were delays in some US projects, we understood why the delay was there. No ship to install the turbines, no foundations, and we talk to them and we understand when they're fixing it, and once it's fixed, the problem is over. But the market is efficient, but sometimes it's a bit slow, and that's our advantage. We try to be quite close to that. But then again, we might go into the company, and then the market might just move for whatever reason, or there might be another unknown, which hits us. But so we do our best to try and understand what's going on and why that's going to be fixed, and that's as far as we can go. And when that's fixed, we try to move.
Hi, Andrés. Thank you for giving new perspective on this company. If you'd asked me to identify the worst Danish large cap company, I would spend less than a second saying Orsted. But leave that apart. How do you assess the risk on the governance structure? Because you got a new management team, you got a board with these government representatives, and they're also facing, as far as the sell side is doing their research, negative.
Facing what, sorry?
Free cash flow is negative from here into the next decade. Net debt will double the next few years. So how is those things factored into your assessment of the company?
So net debt is not going to double. So they plan to fund, they have a 270 billion Danish kroner investment, of which 5% is coming from net debt. So that's going to add 15 billion. They have a net debt of 50 billion. So that's only adding 1/3 to the current net debt. They have negative free cash because they're investing 40 billion a year. So if that investment gives you a 15% return on capital, I'm happy for them to do it. Otherwise, I'd like to have that cash. So, I'm very happy for them to invest if they can get me 15% return on capital. So that's how I think about it. In terms of the government, like I said, I don't really have any insight there. I would just say that the government was there before, and the stock was trading at 1,600. Now it's 380. I haven't actually got the impression the government is bad to the company. They're actually there. They just exist. They don't interfere with the operations. They also have a 7% shareholder, which is a local power company, power and distribution cooperative. And again, they're just existing there. They don't really interfere with the company. So we have had some management change. The chairman resigned or left or whatever you want to call it, and they changed the COO and CFO. We had this chat with the company. COO and CEO was also changed 1.5 years ago. COO. CEO is also relatively new. Yeah, indeed. No, but the recent change was COO and CFO, and I remember having this conversation with the company actually in a meeting here in Madrid, and somebody asking, "Is anyone going to be fired?" And the company was saying, "Yeah, but these guys, they just inherited the problem." But you had a capital markets day in June, and you said everything was good. So some people must take responsibility, right? So I think some of the changes, are the right changes. So I think the company is doing the right moves. If you look at the capital markets day, I think it's quite interesting what they've done and what they accepted. So I think it was a very bad company for some time in terms of accepting projects at very low prices, getting fooled because energy prices go down because turbines are bigger, but there's other complexities, right? But now I think they are biting the bullet. So I think now it's a very good company. But we'll see.
Sorry, thank you for that. And I do, as someone who used to do special sits investing, I like it when someone says it takes me a second to say it's the worst company, because that's about the skeletons of the past, and we're talking about the change. And it's now kind of trading like utility finally. And I struggle a little bit with the kind of arbitrage argument of they can make these IRRs, but someone's willing to pay more for them. But that aside, it looks like the odds are on your side right now, and I quite like this. What concerns me a little bit, though, is, and I realise there's a lot of baggage with the sell side, and there's 22, I think, analysts covering this, a lot of them with vested interests. But the dispersion of like 20, 25 numbers that analysts have out there is absolutely massive. There aren't many companies where you find this huge spread of what people think they will earn in 2025. I don't know the detail on this. So what's going on as to causing that massive dispersion?
So I must apologize because I haven't actually kept an eye on that dispersion. I actually talk a lot with the company. And sometimes we look at the worst, at the analyst that hates them the most. And then I don't really care if somebody expects like something crazy, right? But the numbers are quite visible to the company. So they know exactly the capacity that's coming and exactly the price they're selling it at. The main swings in the last couple of years were coming from, they had a bad hedging in place. And I explained this very quickly. Hornsea 2 should have come at a time. Then COVID came, and so that got a little bit delayed. Hornsea 2 in the UK sells at market price plus adjustments to compensate for that capacity, which is more expensive, and that brings some market exposure to you. So they had sold some of that power, and suddenly the market, went crazy. They didn't have the capacity, and they had to sell the power, so they had to buy the power in the market and sell it lower. So they had a loss there, 3.5 billion. The second big swinging part was they have a division which should make you 1.5, 2 billion Danish kroner out of 20 billion or 24 billion EBITDA, and that's actually selling and they call it thermal power, and also selling gas, trading gas. And they went from making a huge amount of money because, for that reason, exactly, right? Prices for energy went up, they were selling that. Prices for gas were up and volatile, they were trading that and making a lot of money. And then that went down big time, like 6-7 billion down, just to a normalized kind of level. So those have been the most violent swings in EBITDA. But beyond that, it shouldn't be a very difficult company to put your finger on in terms of EBITDA. So I'm not so sure why some people, I mean, we've talked to the most detailed analysts out there and went through everything and through every line. So I will have to look to see who's actually an outlier to understand. But yeah, so this is what the company see.
Anybody else? No? Thank you so much.
Thank you.